Why do I like return to drawdown ratio as a quick metric for evaluating investing and trading systems? This is Bill Scheid from Applied Finance Research, and that's the question we're going to answer in this video. So in short, the reason I like return to drawdown ratio is it gives us a quick way to assess the value of trading a system or investing in a system versus any other system or any other strategy like buy and hold. So for example, here we have a bunch of results for different systems with a variety of different metrics. And right in the middle here, we have return to drawdown ratio. So what happens if we just scan across and without looking at any other numbers, we just look for the highest return to drawdown ratio, and we have it right here at 61.1. This is a momentum system that we teach in our courses and includes our volatility stops and short positions. And let's ask ourselves what we would be getting ourselves into in terms of return and drawdown for this system if we just chose this system based only on the return to drawdown ratio. So this would give us a total return of 960% over the backtest period on a maximum drawdown of only 15.7%, which is how we get this very high return to drawdown ratio. Well, what else would we be getting ourselves into? We'd have a compounded annual growth rate of 16.4%. We would have an ending balance of 1.14 million actually, and that's the hypothetical balance of an account that assumes a $100,000 starting balance and 16 years of growth at the given CAGR for this backtest period. Based on SQN, we'd have an excellent SQN of 4.05. So that's what we'd be getting ourselves into if we chose the largest return to drawdown ratio number. And what if we scanned across and we just looked for the lowest one? So here we have 3.4. That comes from a 60-40 buy and hold approach, 60% diversified equities, 40% diversified bonds. We'd have a total return of 116.9 on a maximum drawdown of 34.7, which gives us our return to drawdown ratio of 3.4. We'd have a compounded annual growth rate of 5.1. And if we want to ask ourselves what else we'd be getting ourselves into, we'd have an ending balance of 221,000. So here we see that return to drawdown ratio gives us an excellent way to compare these two systems. And we can see there's a lot of extra value in choosing this system versus 60-40 buy and hold. Now, let's compare return to drawdown ratio to a few of the other metrics. SQN is a metric I personally really like using, popularized by Dr. Van Tharp. And return to drawdown ratio gives us a good sense of the system, but it doesn't always correlate with SQN. So for example, let's scan across and we're going to look for the second highest return to drawdown ratio. And here we have it at 45.7. But notice that this one is actually the highest SQN. So it's not necessarily true that the highest return to drawdown ratio will produce the highest SQN, which is why actually I like to look at both. But let's ask ourselves, if we just looked at return to drawdown ratio and we picked this one, what would we be getting ourselves into? We would have a return of 644.3% on a slightly lower drawdown of minus 14.1%. So here we see that we've given up some return here, about 320-ish%. Let's just round it off there. But we've only gotten a slightly lower maximum drawdown. So here we have our return to drawdown at 45.7. Now this system does have an excellent SQN and an excellent expectancy. This is one of our hybrid systems with the volatility stops and shorts. And this system may work well for an individual investor or trader's objectives. For example, if they said they wanted to keep their maximum drawdowns below 15%, but they still wanted some high returns, that could be an excellent choice for them. And then looking a little bit further, let's say we take a look at, for example, the lowest return to drawdown ratio of any of the systems outside the S&P and 60-40 buy and hold. We have 8.9 here for our system PMA low. Now, how did we get a lower return to drawdown ratio for this system? That's because this system has the lowest maximum drawdown, but it also has the lowest total return. And it's not particularly surprising to see that, considering the fact that we developed the system specifically to have lower maximum drawdowns and and of course sometimes along with that means we have lower returns, but not always, because if we look at the last system we were just checking out, we have a similar low maximum drawdown, but we have a much higher return for the hybrid system, hence that higher return to drawdown ratio. So we could go through and compare any of these numbers, but we see that in short, using return to drawdown ratio helps us get a quick sense of what is the value add for any system versus, for example, another choice we could make is just buying and holding the S&P, which does have a pretty solid return, 323%, but then we have to deal with a maximum drawdown of minus 52.3%. So that brings our return to drawdown ratio way down to 6.2 versus some of the other systems here. So it gives us a quick way to see the value add, and I like it because psychologically speaking, we all want the return and we don't want the drawdown, right? Everyone would just buy the absolute most volatile thing they could if all we wanted was return and we didn't care about drawdown. But we actually care about both, and our psychological experience, our sense of comfort, and how stable and reliable we feel about our choices investing and trading wise are going to be impacted not only by return but also by drawdown. So we all want the return, we don't want the drawdown. Return to drawdown ratio is an excellent way to give us a sense of what is the value of the system, how much return are we going to get, and how much drawdown do we have to put up with. This is Bill Scheid from Applied Finance Research. Thanks for watching and happy investing.